The journey from startup to IPO. Before we learn why do companies go public, let us use up some time working out a more basic idea about the start of a certain sort of business. To get through knowledge of this idea better, we will make a touchable story around it. Let us split this story into several scenes. Scene 1: The Angels. Let's just say a guy named Raj, who has an excellent business idea, a car that runs on the water for a very cheaper price. As a typical entrepreneur, he is likely to be hit by the typical problem: where would he get the money to fund the idea? Assuming the entrepreneur has no business background, he will not attract any serious investor at the initial stage. Chances are, he would approach his family and friends to pitch the idea and raise some money. He could approach the bank for a loan as well, but this would not be the best option. Let us assume that he pools in his own money and also convinces two of his good friends to invest in his business. Because these two friends are investing in the pre-revenue stage and taking a blind bet on the entrepreneur, they would be called the angel investors. So let us imagine that the promoter along with the angels raises 6 Indian rupees crore in the capital. This initial money that he gets to kickstart his business is called the seed fund. The venture capital. Let us assume he meets one such professional investor who agrees to invest in Raj company. The investor who typically invests in such an early stage of business is called a venture capitalist. Scene 3: The banker. The company is phenomenally successful. The company can approach a bank and seek a loan. The loan is also called debt. Scene 4: Private equity. A few years pass by and the company's success continues to shine on. The company decides to raise the bar and branch out across the country. The company does not want to raise money through debt because of the interest rate burden, also called the finance charges, which would eat away the profits the company generates. They cannot approach a typical VC because VC funding is usually small and runs into a few crores. This is when a private equity (PE) investor comes into the picture. Scene 5: The IPO. The promoter now aspires to go international. Since the capital requirement is very high, they approached public. The general public will subscribe to the shares by paying a certain price. Now, because the company is offering the shares for the first time to the public, it is called the initial public offer.